All right, everybody, this is Kevin McGrath. We'll get started now. I appreciate everybody's time and joining us this afternoon to talk about donor-advised funds. As I said, my name is Kevin McGrath. I'm with Renaissance Administration. I've been with Renaissance for about 20 years now, well, actually a little bit over 20 years, and most of that time has been spent in our consulting and sales area where I help financial professionals, donors, clients, planned giving professionals find ways to use charitable tools to meet their needs. So let's get started. Like I said, we're going to talk about donor-advised funds. Appreciate everybody's time today, and we'll jump right in. So today's agenda, what we're going to talk about, like I said, donor-advised funds. We're going to talk about what a donor-advised fund is, how a donor-advised fund works, how a donor-advised fund differs from maybe a family foundation, and we'll also mix in a little bit of remainder trust and lead trust and other giving strategies. We're going to talk about how you start the charitable conversation with your clients. We're talking about some of the trends that we're seeing in the donor-advised fund space. And then we're going to talk a little bit about Renaissance Charitable Foundation and what makes Renaissance Charitable Foundation a bit unique. So let's first talk about the landscape. There we go. Now we're moving. So I said we're going to talk a little bit about the landscape. So even though I've been in the industry now for quite some time, in the charitable world anyways, but one of the things that always surprises me is every year when they put out the Giving USA numbers, and I don't know why it surprises me after seeing it for this many years, but is the amount of giving that's done in the United States for charitable causes. And in 2014, actually 2015 was our greatest year of giving ever, but in 2014 about $360 billion was given to charities. And what surprised me the most, I'm coming to you live from Indianapolis, so when I talk about my area, I'm talking about my own backyard here in Indianapolis. But what surprised me most is that when I read in the papers or I see in the papers and things are being written about philanthropy, often it's about the big foundations that are in the area, big community foundations and hospital foundations and the Lilly Foundation and the IU Indiana University Foundation. And when in fact that 72% of all the giving in the United States comes from individuals. So if you see a lot in the presses around charitable giving, it kind of makes you think about all of the big corporations and big foundations that are doing giving, but really 72% of it's our clients. And I also find the next point a bit remarkable as well too, that in studies it is shown that those that have over $1 million of assets, 98% of them give to charity. So a very large percentage of our clients are giving to charity, and a very large percentage of the overall giving to charity is coming from our clients. So that kind of lays the landscape for the question of, are my clients charitable? And it's kind of one of the questions that we ask often, are my clients charitable? Because I'm not going to be talking about charitable tools with them if we don't think that they're charitable. So this slide would lend you to believe that most of your clients are charitable, without even asking them the question if they're charitable or not. Donor-advised funds. And here's a little bit more of the landscape. And this is the growth of donor-advised funds between 2013 and 2014. In 2014, almost 8% of all charitable giving contributions were to a DAF, to a donor-advised fund. So some might say, well, hey, how does that fall into charitable giving if it's going to a donor-advised fund and it ultimately hasn't been distributed out to their favorite charities? Well, a donor-advised fund is a charity. It's sponsored by a charitable organization. And so that's counted as gifts made during that year. So 7.6% of all giving in 2014 went to donor-advised funds. Also in 2014, contributions were about $20 billion in total assets under management, grew to almost $71 billion in donor-advised funds. So a very big marketplace. And the overall growth, or assets under management, grew between 2013 and 2014 at about 24%, from $57 billion to about $71 billion. The total contributions changed during that year. During 2013 was $17 billion, grew to $19 billion, or almost $20 billion. So the growth of contributions was about 14.1%. The total granted dollars out of donor-advised funds, and these are remarkable statistics, are almost $10 billion and $12.5 billion and the growth over that time period is about 27%. And if you think about the market during 2013 and 2014, they may have not been for all of our clients, and I'm overgeneralizing there, but it may not have been for all of our clients the best years of giving. So if they looked at their portfolios in 2013 and 2014, maybe you wouldn't have guessed that they were going to do a lot of charitable giving, but what those years proved were, even as hard as they might have been on their portfolios, on the clients' portfolios, people were using donor-advised funds the way they should be using donor-advised funds. So maybe they were putting away their checkbook, or maybe they were putting away their contributions that were going directly from their investment accounts to their favorite charities, and instead they were using their donor-advised funds like they were supposed to use their donor-advised funds and do their normal giving from there. So again, even during periods of down markets, and maybe not all of our clients experience down markets then, but during those periods, people still give out of their donor-advised funds, and in fact, they might even give more. The total number of donor-advised fund accounts grew between those years on average from 218,000 to about 238,000, so about 8 almost 9% growth. And the average size donor-advised fund account, I got ahead of myself, I'm sorry. The average size of donor-advised fund account went from about 218,000 to 247,000, which was a growth of almost 14%. So if you look at the other charitable tools, and we'll mix some of this conversation into this presentation today, but if you look at some of the growth of other charitable tools, it kind of shakes out like this. So in 2013, 2014, we already said the donor-advised funds had grown almost 24%. And in that same period, the charitable remainder trusts, the growth was actually almost a negative 4%. So if you don't know this about Renaissance, we administer about 5,000 remainder trusts. And so when we look at our portfolio of remainder trust and the growth or lack of growth, and then we also look at the closeout through natural attrition, we look at the periods of time where the remainder trust was the most popular, and it really was the late 80s, mid 90s. That's when we were seeing amazing amounts of remainder trust being established. And if you look back at the markets, that would help us dictate, yep, that's why it happened. We also went through a period of high property values, so we were seeing real property and also a lot of stock contributions and remainder trusts. Well, if you think about those people that were funding those trusts in the late 80s, mid 90s, and even into the almost into the later 90s as well, there's almost a 10-year period that we saw some significant growth with the remainder trusts. That you looked at that age group now, it makes sense that a lot of those are through natural attrition, through the death of the donors and income beneficiaries. Those trusts are closing out almost faster than they are being funded. So it's reasonable to see negative growth in the remainder trusts. And the private foundations still continue to see growth at about 6%. And then in the charitable lead trusts, also if you don't know, Renaissance administers a lot of remainder trusts in addition to a lot of lead trusts. We live in a perfect environment with low interest rates for the charitable lead trusts. We won't get into that. That'll be for another discussion or another webinar. But we're living in a great society and a great environment for charitable lead trusts right now, so it's very reasonable that we would see growth in the charitable lead trust market. So let's talk about the basics of what a donor-advised fund is. And you know what I forgot to mention? If you have questions, go ahead and use the chat. If you're comfortable using the chat, go ahead and use the chat and just submit questions. And then at the end, I'll address those questions. So I apologize for not doing that housekeeping up front. So submit them if you got them. So let's get back to donor-advised funds and the basics of what donor-advised funds is. I said earlier that a donor-advised fund always has a charitable component, and then the charitable component is the sponsoring charity. So when our clients or our donors make contributions to the sponsoring charity, they get a deduction for making that gift. And then that sponsoring charity will allow them, they're the umbrella if you will allow them to have an account. And from that account, they'll be able to make distributions to whatever charities they want. So they can distribute to their favorite charities monthly or quarterly or 5 times a month or once a year or once every 5 years. So they determine how often and to what charities they'd like to submit a grant request to. So the donor makes a one-time gift to the sponsoring charity. Now I'm going through the steps. They receive a deduction for doing it. They get a fair market value deduction for doing it in almost all cases. And then the donor, like I said, recommends grants to whatever favorite public charities of their choice are. So, a lot of people ask us, well, what's the limits? How many grants can a donor do throughout the year? And we don't have any minimums. We don't have any maximums. There's no regulation currently that says that they have to distribute annually. There's no regulation that says that they have to distribute in the first 5 years. And then Renaissance, in most all donor-advised funds, not just Renaissance, don't limit the number of grants that you can make out to your favorite charities. So a lot of times, I like to ask the question, what charities do you give to now? And the national averages would tell you that we have 5 to 7 favorite charities, somewhere in that ballpark. We all have 5 to 7 favorite charities. And you really don't see giving patterns change much. So if they were used to doing checkbook giving, and now they're doing their giving out of their donor-advised fund, it's reasonable to think that they would make grants out to those same 5 or 7 charities out of their donor-advised fund. So it really doesn't change their giving patterns much. So one of the things that you can do with donor-advised funds is unlock potential assets or assets maybe that maybe the financial professional is not managing. By far, the 2 or 3 most common contributions we see to donor-advised funds are cash, and then I say generically securities, but we see stock in mutual funds. And of the cash, stock, and mutual funds, it's probably a 60-40, 65-35 split, somewhere in that ballpark between mutual funds and stock versus cash. So we see about 2/3, at least, of our contributions being some form of securities. And although it's not that common, we do a fair amount of real estate, and this would be true of many donor advisement programs. Real estate, either raw land, residential, commercial property, farmland. We have done a number of closely held businesses, contributions of either shares or the entire corporation to the donor advised fund or to the sponsoring charity. And then we also see tangible personal property. But then again, it's probably a much smaller percentage than it would be compared to cash, stock, and mutual funds. So I made the statement earlier, put away the checkbook, and it really is one of the strategies behind donor advised funds. So it's so simple to set up, and it's so simple to do grant requests or grant recommendations from, that most people will use their donor advised fund to do their normal annual giving that they would have done by their checkbook. So many people that use their donor advised fund actively are essentially putting away their checkbook. And if you think about sometimes the inefficiencies there are, tax inefficiencies, I should say, with checkbook giving, a lot of times I hear financial advisors say, yeah, my client's normal giving would be, they have a certain amount of cash reserve, they have a certain amount sitting in their checking account that they're comfortable with, and whenever it gets below their comfort level, then they give me a call, and I'm selling something or generating some sort of cash to replenish that cash reserve. So it's potential that we're creating tax to create cash to create gifts, where instead we could take those appreciated stocks or mutual funds, whatever they might be, put it in the donor advised fund, avoid the tax, and then do our normal giving from there. So in a lot of cases, this is one of the drivers of people using donor advised funds, is their willingness and ability to put away their checkbook for their normal annual giving. So I mentioned before, there is an ability to unlock some illiquid assets or assets that wouldn't traditionally been thought of to make as annual gifts. The only caution that I throw out there with gifting illiquid assets would be work with the sponsoring charity. So before you have a conversation with the donor, before you have a conversation with the client, just have a conversation with whoever the sponsoring charity of the donor advised fund is to say, will you accept these types of gifts? And if you do, what steps do I have to go through to get my client to transfer these? Because it might be at the end of the day, and this happens a lot, it might be at the end of the day that asset might not be able to be transferred, or it might be enough of a headache for the client to transfer the asset that they may choose just to use some other asset like a stock or mutual fund to fund their donor advised fund. So my caution or my comment or suggestion is I would work with the sponsoring charity to make sure that they're comfortable with accepting that type of gift. So let's look at some of the features and benefits. And some of these I've already thrown out there, and we'll skip through those pretty quickly. So from a tax planning standpoint on the donor advised fund, there's a lot of benefit. Some of the biggest benefit we hear from donors is that there's no legal work and there's minimal costs, and it's extremely simple to do. So we can fund one of these things with maybe $5,000, and it didn't have any legal work attached to it, and there really wasn't any cost of setting it up. So that's one of the big benefits that we hear from a tax planning standpoint. Avoid capital gains. That's one of the big drivers of the growth of donor advised funds, is the ability to put in something appreciated, sell it, avoid the gains, and get a fair market value deduction. Dilute concentrated positions. I'm sure no one on this call has ever heard their client say, no, I don't want to sell that because I don't want to pay the taxes. But if you have heard a client say something like that, this is a great way to dilute a concentrated position that's highly appreciated, is I could contribute it and I could sell it inside the donor advised fund and not have any capital gains taxes. We've said it, the fair market value deduction in most scenarios, and then I'm going to hit on this one in a second here, the higher valuation on assets that aren't publicly traded. And I'll hit those 50-30-20 rules here in just a second. And the ability to spread out giving over time. And this is one that we're hearing more and more and more. Maybe this one should bump to the top of the list. So this ability to spread out giving over time. We hear a lot of individuals that are using donor advised funds almost like they are like retirement planning. And so during your lifetime, you're accumulating wealth, right, that hopefully during your retirement phase is going to sustain your lifestyle. So you're accumulating during your working years and then spending those saved dollars during your retirement years. And we hear a lot of people funding donor advised funds to do the very same thing, that they have this fear, they're philanthropic today, but they have this fear that in retirement they won't be able to afford to sustain the type of giving that they do today. So one of the ways that we help them do that is that they make annual contributions to their donor advised fund, allow that fund to grow, and then during their retirement years they can use that fund to continue their charitable giving. So we're hearing a lot more of this one, and again, maybe this one should bump to the top of the list, but planning for retirement and giving is a big to-do these days. From an estate planning standpoint, some of the best assets you can look at would be those qualified assets like an IRA, so leave by way of beneficiary designation, an IRA to a donor advised fund to avoid estate taxes. You'd avoid the income of the respective decedent taxes. It's a very tax-efficient way to fund future giving. The remainderment of a charitable remainder trust, this one is huge, and I'll talk about it now, and I'll talk about it a little bit more in a couple more slides. So it's interesting. If I look back to when I first started at Renaissance, and most all of the administration we did was remainder trusts, I would tell you that probably 90% of the remainder trusts that we helped establish also had a life insurance policy that replaced the wealth to the heirs that just got disinherited because mom or dad funded a charitable remainder trust. And I will tell you that now almost all of our conversations involve mom and dad saying, well, our children are much better off than we were when we were their age, and they're set in other ways, and so they're earmarking some of their estate assets or charitable remainder trust assets to a donor advised fund that the kids or the heirs will be the grant advisors on. And it's amazing how they don't see that as a disinheritance anymore. So it's a remainder trust, and at the end of the term of the remainder trust, it dumps into a donor advised fund. Mom and dad are now deceased, and now children or heirs are the grant advisors on this donor advised fund. It's a very powerful planning strategy. Very similar to the remainder trust, we see and have a lot of conversations around the charitable lead trust paying the lead interest to a donor advised fund. So a CLT could fund a donor advised fund that then could fund future giving. very powerful. And I already said that we're living in an environment where the CLT is very powerful right now. The ability to name successor grant advisors, so we keep on dribbling on this throughout the entire presentation, but using myself as an example, my wife and I have a donor-advised fund, and our successor grant advisors are our children. So at our demise, our children will take over the donor-advised fund as grant advisors and make grants out to the charities that are important to them. Build a legacy. I mean, that's what we're doing. In my family, that's what we're doing. We could also build an endowment. So at our demise, we could have this donor-advised fund pay out a certain percentage or a dollar amount to our favorite charities and maybe last in perpetuity. And involve family members, I've already mentioned a couple times. So one of the strategies I wanted to stop on a little bit and spend a few minutes on is, and this is one we're hearing a lot of conversations or having a lot of conversations about, is the private foundation versus donor-advised fund. And then beyond that, we're having a lot of conversations around private foundations funding donor-advised funds. So here's some of the differences, and this is the real quick high-level differences of a private foundation versus donor-advised fund. So I said the 50-30-20 rules, the income tax deductions, the amount I can take against my adjusted gross income are typically higher with the donor-advised fund than they are for the private foundation. The valuation of publicly traded securities, it's a fair market value deduction for both. The valuation for non-publicly traded securities, it would be a fair market value deduction for a donor-advised fund, but it's actually cost basis for a private foundation. I said in the donor-advised fund there's no establishment costs, there's no legal drafting, there's no upfront fees. In nearly all donor-advised funds, there's no upfront fees. You can fund them, you can establish them in minutes. They're not difficult to do, they're very simple. The annual grant requirement is not part of any regulation today. Very well could be tomorrow, but it's not today. In the donor-advised fund, it is in the private family foundation, it's 5%. Both of them have, and you can look around, both of them have pretty wide investment option investment options like for, sorry, lost my train of thought. So investment options for investments into the funds themselves. So once the contribution's made, sold, and invested, most of them have a very broad investment policy statement. Administration is included typically in the fees when you see it. In privacy, this one tends to be actually a very big one, especially for the wealthy. And I really don't know how to define wealthy in most conversations. But privacy tends to be a big one, and people really like their donor-advised fund because they can make anonymous gifts, and they don't want everybody knowing who they feel strongly about or who they're making gifts to. And the ability to make a gift to a charity and have it be a secret is great news to a lot of people. So collapsing a private foundation, it's actually a very simple process. So a lot of times, maybe mom and dad or grandma and grandpa, somebody has set up a family foundation, a private foundation, and the kids or the heirs aren't necessarily that enthusiastic about it, and they're looking for a little bit of simplicity in their life, and it's really a simple process. So you would collapse the private foundation by typically notifying the Attorney General and the IRS. You distribute all the funds out of the private foundation and into the donor-advised fund. And then you would complete the final Form 990 for that calendar year. So one of the questions I do get often is, can we do the reverse? So if I had a donor-advised fund, could I collapse it into a private foundation? And I'm sorry, the opposite, yeah. So that if I had a donor-advised fund, could I collapse it into a private foundation? And the answer is no. Unfortunately, you can't go from public to private, but you can go from private to public. So starting the conversation, and this is sometimes where some of us have some troubles, is how do I talk about these things, or how do I talk about donor-advised funds and philanthropy in general? Well, some of the things that are triggers that should start conversations anyways are anybody that has a concentrated position and is philanthropic. So if they're somebody who likes to give to charity and they have highly appreciated assets, most of the time investable assets, they're a good person to talk to. Somebody with low cost basis and highly appreciated assets is a good candidate for any type of charitable giving. And today we're talking about donor-advised funds, so they're a good candidate for donor-advised funds. Anybody who comes into a windfall of income, so it's a non-traditional or a non-typical year. So in 2016, my income is greater than it has been in prior years and maybe greater than future years. That might be a good year to fund a donor-advised fund. Somebody who has recurring year-end transfers, so somebody who's calling you every December and saying, hey, I'd like to transfer securities to these 5 or 6 or 10 charities. Somebody has concerns about teaching values to children, so they want to get them involved in philanthropy to pass on values to their heirs or their children. And retirement, I've already mentioned that one. These are people who are saving for their retirement and their future philanthropy. And a sudden change in lifestyle. So this could be retirement or divorce or a death or a serious illness, something that's caused normal lifestyle to change. Might be a good time to talk about donor-advised funds. So the charitable conversation, and lots of people like to do this in lots of different ways. Some people just simply ask, what are your favorite charities that you give to and why? And I would tell you that of that two-part question, it's the why part that's the most important, because they say most purchases are based on emotion, and so it's why, it's the emotion as to why I give to these charities that really means something to me. It's not the physical check that I give them that means something to me. It's the why. It's what they do. So I ask people all the time, how are you currently supporting them? If I showed you a better way or a more tax-efficient way to do it, would you be interested in listening? Yes. I sometimes ask people, I don't know if anybody's ever done this one before, but I sometimes take the 1040 instruction booklet, and in that booklet, I don't know, somewhere around page 90, maybe it has a graph, and it's a graph of all of the dollars that were taken in for taxes by the federal government and how those tax dollars are spent by the government. And I say, if you could redirect all your tax dollars and you could draw your own graph, what would your graph look like? So instead of 9% of all your tax dollars going to pay the interest on the debt, would you rather redirect those dollars to the charities of your choice, and who would they be and why? So I love walking through that exercise. It's a different way of asking the who and why. And then the last one, are you considering leaving money to charity in your will or in your trust? Anybody who's doing that may be interested in using a donor-advised fund today. One, they would get it established and it gets the plan in motion. And two, at their demise, if their will or trust does name charity, it instead could go to the donor-advised fund that would be then distributed to charity. So it could be used like an endowment. And you know what? A lot of people really think of giving a very large check to charity very similar to giving a very large check to their children. They would rather give them a stream of income than give them a very large check. And quite frankly, a lot of charities would rather know that they're going to get a long-term stream of income instead of a large check. So enhancing your practice. So here's a couple of the things that I think of when I think of actually all philanthropic giving and including it into financial planning or overall financial planning and how it enhances your practice. One, I mean, it's just providing good, tax, simple, smart, charitable solutions. So obviously the more you have, so the more you can save in taxes, the more you have, the more you can give. It's a simple scenario. So create stickier client relationships, and everybody has different terms they use. I like to use stickier, not that it can't leave, that it's stuck to me, but more it's values-based. And so it tends to be, any philanthropic assets tend to be more in family philanthropy or more in multi-generation planning than lots of other types of planning that's out there. Create a venue for the next generation. So I kind of touched on that. So again, it gets the whole family involved, gets the next generation involved. It's sometimes philanthropy is the entree into the next generation. So maybe I'm working with mom and dad and kids are working with some other financial advisor, and by talking about philanthropy as a family and planning together, maybe it's an ability for you to to get in front of people that you're not working with already, which would maybe be the next generation. And obviously, it increases assets under management. So in the first one, I said increased tax savings. You have more, you give more. Well, if you save more, you have more, you invest more. So it can also increase the assets under management. And then we talked about unlocking some of the non-publicly traded assets. But again, work with the institution that's sponsoring the donor-advised fund. So here's a couple of the trends, and I like to hit on them throughout the way, so none of these are probably actually a surprise to you. So alongside a foundation, I think I touched on this a second ago, but a lot of times we'll see a private family foundation or a private foundation that will make grants or distributions out of the foundation because it's required to into a donor-advised fund. So we see that being used quite often. The beneficiaries of a CRT, I already mentioned that one, very powerful planning strategy. Again, somebody, I'm using mom and dad as an example, fund a remainder trust. They're the income beneficiaries for life, and when they die or when they pass away, all the money dumps into a donor-advised fund that maybe the heirs or the kids or the grant advisors are on. Again, very powerful strategy. Beneficiary of an IRA, again, very tax efficient way of giving, using qualified money to fund future giving to charity is extremely tax efficient. More engagement of children and family, we just talked about that, big trend. Again, we're hearing lots still. We've heard for the last 16 years since we started doing donor-advised funds that it really is a solution that families sit around the table, whether it be at Thanksgiving or some other time, and they talk about their family giving. And so it really engages family often. And again, I think it's somewhat because of the simplicity of it that it's engaging. You know, they don't have to do a lot. It's a smarter, much savvier tax planning tool. So again, put away your checkbook, fund your future giving today. If your current lifestyle supports funding it today, meaning that this year my income is greater or I had a windfall of income, if I had a big tax event that I want to offset, if something was different this year that made my taxes greater, then this might be a good, smart, savvy way of future funding of philanthropic dollars. More regular conversations between advisors and clients. I hear this. I'm not a financial advisor. I don't have personal experience with this, but I have a lot of advisors tell me that when they start using philanthropy in their conversations, it really becomes part of the conversation in their year-end meetings that is much different than what they expected. You know, so whereas a lot of times you're meeting with clients, you're talking about projecting, you know, their current savings and their retirement age, and is it going to sustain that? And it's a lot of graphs and a lot of numbers and a lot of analysis. Whereas they say that the clients that they're doing philanthropic planning for, really they're having much more regular and fun conversations with their clients. So let me tell you a little bit about Renaissance Charitable Foundation. So Renaissance Charitable Foundation is the sponsoring charity for donor-advised fund programs. We've been around since about 2000. So we have a Renaissance Charitable Foundation, and then we have a Renaissance Administration. Renaissance Charitable Foundation is the charity that sponsors donor-advised funds, and Renaissance is the administrator of that foundation. I should update this slide. It's closer to $1 billion in assets in the foundation. It's a very cost-effective way of giving. Administration fees average around 60 basis points in the industry. That's about where we average as well. Advisors determine their own fees on separately managed accounts, or if they're using funds that have 12B1 fees. So however you normally get compensated, you would get compensated in most of the programs that we administer as well. The administration partner, like I said, is Renaissance Administration. We've been around for pretty close to 30 years. We actually administer now closer to $7 billion of charitable assets, and we utilize our entire centers of excellence. And what I mean by that is that we've got legal support services, we've got accounting support services, we've got fiduciary services, we've got administration, we've got sales and consulting, we've got marketing, and all of these are available to all of our clients to help them with their charitable giving. What makes us unique? One, we're custody neutral and investment neutral, so we're not a bank or an investment company. We have a deep, long-standing expertise in charitable planning, and we do all types of charitable gifts like I've talked about, remainder trusts and gift annuities and lead trusts and private foundations and donor-advised funds and endowments. If it's charitable, I say we administer it. So we have a very broad base and deep understanding of all philanthropic tools. So it's unbiased. When I'm doing this presentation, I have to catch myself when I'm comparing to other planning strategies, because I don't want to sound like just because we're talking about donor-advised funds today, I'm favoring it. I think all tools meet the fact patterns of our clients, and we need to figure out what tool makes the most sense. So we have an unbiased opinion towards each of them because we administer and do all of them. We have the ability to facilitate gifts of non-publicly traded assets. So we have this reputation in the industry, especially in the charitable remainder trust world, that we process lots of unique assets, and we really do. And part of that's because, again, our experience with the remainder trust is that these trusts have been funded with unique or illiquid assets, and we've carried that experience over into our donor-advised fund. Now, that doesn't mean that our foundation will accept all of the same assets that we've seen go into remainder trusts, but it's absolutely worth having. And again, I say make sure you're having those conversations with the sponsoring charity before you have them with the client. We just don't want to put the cart before the horse. Very cost effective. All right, coming into home stretch here. So conclusion, why do we see people using donor-advised funds? And I will tell you, it's really these four things. They're simple, simple, simple. And at the end of the day, whether we say it's tax efficient, it almost always comes back to it was simple. It was very easy to understand. It was very easy for me to utilize this tool. It was easy to fund it. It was easy for my financial advisor or attorney or accountant or whoever to explain it to me, and I understood it, and I did it because it was simple and it was easy. Very tax efficient, very cost effective, and very flexible. So people are using donor-advised funds for many different reasons. But at the end of the day, they're doing it because they want to be tax efficient and they want to benefit the charities they feel strongly about. So we are now going to open it up to a few questions. And I'm going to look at these in no particular order. So the first question comes and it says, are my presentation, my slides going to be available after the webinar? And yes. And they will also be on YouTube. So the next question is a great question, and I wish that I would have brought this up. This comes from Mike, and it says, can you donate your RMD directly to the DAF? And actually, no. And I apologize for not saying that because that's probably one of the most common questions that we get right now in funding it. So the question is, can I take my required minimum distributions and fund a donor-advised fund with that required minimum distribution? So here's where I think it's a long list of areas where the IRS has gotten things wrong, and this is one of them. I think that if we allowed people to make distributions, or the required minimum distributions, I should say, to their donor-advised funds, people would do it. And we see on average of all the programs that we administer, the average spending rate or distribution rate of donor-advised funds, however you want to look at it, being somewhere around 20%. If people use their RMD to fund their donor-advised funds, they would then make distributions to charity. And so I hope that's changed. It can be changed someday, so hopefully it will be. The next question is, are there any limits to the charities that a donor-advised a donor can make grants to? And yes, it has to be a qualified public charity. And one of the questions that I get all the time is, well, I've heard about donor-advised funds that you're only recommending a grant and that the charity can say no. So Renaissance Charitable Foundation, you can say no. I will tell you that we've never said no to a grant that was to a qualified charity and for a qualified purpose. So the question was, are there any limits restricting or the types of charities that you can make grants to? And yes, it's public charities, but it still has to be for a qualifying purpose. So for example, I'll use my alma mater, I can make a gift to Purdue University out of my donor-advised fund, but what I can't do is I can't say I'm making a gift to Purdue University to pay my child's tuition. So that would be a non-qualifying event or a non-qualifying purpose, so that grant would get rejected. It's a good question. How much influence, this is the next question, how much influence do advisors have in the management of the assets in a Renaissance DAF? It's a great question. And I would encourage the person, because it's a very, very broad answer, I would encourage the person that asked the question to give us a call. And my direct line is shown on the slide right there at 317-757-3432. It's another great question. So another question that we got is, can I recommend out of a donor-advised fund, can I recommend an individual as a recipient of a scholarship? And the answer is no, you cannot. So most donor-advised funds do not get sold or described as a scholarship fund because, as you know, a true scholarship fund is making distributions to an individual. And in that last question, I told you that it has to be to a public charity. So what I could do is, let's say that I wanted to offer an electrical engineering scholarship for $5,000 at Purdue University. I could certainly make a distribution out of my donor-advised fund to the electrical engineering school or the School of Electrical Engineers. I could make a grant to that school, and then the school then could use those dollars to fund a scholarship. So there are ways to do it, but no, you can't cut a check directly to an individual. Let's see if I missed any here. Here's a good question that comes from William. Is there a typical amount of time or cost to process a non-publicly traded asset? Very good question, and it depends on the program. So let me talk generically just about all donor-advised funds instead of just about our own. And then if you have a specific question, William, about our own, you can give us a call. So generically about all donor-advised funds, most donor-advised fund programs will have what I call a receiving account. So if I'm an investment advisor at broker-dealer A and I'm managing my client's personal assets and I want to make a contribution of stock to fund a donor-advised fund, that sponsoring charity probably has a receiving account somewhere that I would transfer those shares to. And however long it takes to DTC those shares, that's how long it takes to fund the donor-advised fund. So in most cases, it takes maybe 24 hours to fund a donor-advised fund or to fund an account with the client's assets. Let's see if I missed any others here. So I have one on what is the fee to administer donor-advised funds. They range. They range on all of the donor-advised funds that we administer here at Renaissance. They range, and this is on the first, usually $500,000. It's usually a basis point charge, but most of them are between 60 and 95 basis points on the first $500,000. So again, we administer quite a few different programs, and looking across all those programs for the first $500,000, depending on the program, it's somewhere between 60 and 95 basis points for the first $500,000. And now the next question is, can I manage my client's assets inside the DAF at Renaissance? Yes. In all scenarios, we have to have. So if I looked at all the programs that we administer, we have to have an investment advisor that manages the assets in the donor advised fund because we are not an investment management firm and we don't do investment management. So we partner with the investment advisor, if you will, in all cases to do the administration or to do the investments inside the donor advised fund. I think I've hit all the questions now. Again, I very much appreciate everybody's time. Had some great questions in there. Hopefully you got something from this webinar, and hopefully you join our future webinars. So thank you again, and have a wonderful day.